Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direxion's daily aerospace and defense bull 3X shares. Don't miss your next big trade. Direxion leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direxion shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.direxioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
The stock market doesn't beat anyone. People beat themselves. Coming up on today's program, we're going to talk about the rebounding market. Also, a rescue plan for retirement late savers. We'll tell you all about that. We'll also get into your emails, calls, and our Twitter feed. If you'd like to join us to talk about your own portfolio, a particular stock, mutual fund, ETF, or investment strategy, 844-305-7800. That's the number to give us your first name along with your city and your ticker symbols. Again, 844-305-7800. Taking a look at the CNN Fear and Greed Index, a measure of what the market sentiment is, emotion-wise. Taking a look at that, we've got extreme fear. Currently is the reading, even with that rebound that we've had so far here in November, it's at an 8. Now remember, the Fear Greed Index measures fear and greed. When the market's fearful, you're going to see a downward push. When it's greedy, you're probably in an upward swinging market. And we've been in greedy territory for most of 2018. Now we're in extreme fear territory. So the numbers, just to help you understand this, 0 is extreme fear. That's as bad as it gets. 100 is extreme greed. That's, I guess you might say, as good as it gets if you want to call greed good. But we're at an 8 right now. So 0 is the worst for fearful investors. We're at 8. 100 is greedy. So that just helps you understand how extreme market conditions are right now as far as sentiment is concerned. Taking a look at some fundamental measures like earnings, third quarter earnings for S&P 500 companies. We're continuing to get more and more earnings. We're almost done with third quarter earnings. So far, we've got 75% of companies in the S&P 500 reporting actual results. So the question is, how have results been? Have they been good or have they been bad? Well, in aggregate, they've been quite good. According to FactSet, earnings are almost 7% above estimates. That's earnings estimates from analysts, which is also, by the way, above the 5-year average. So that's good. And we've also got, if we take a look at this from a sector angle, all 11 sectors within the S&P 500 are reporting year-over-year earnings growth. In fact, 9 sectors even have double-digit earnings growth, led by energy, financials, communication services, and materials. So that's what's going on in terms of earnings. In terms of performance, we'll get you caught up a little bit later on what's happening industry sector-wise and some of the key ETFs tracking them. And before we do that, though, how are you doing? You've made it. We're alive. It's November. We know that historically October has been a hellish month for equity investors. Of course, October 2018 was no different. We gave you historical perspective about just how bad it was. We haven't had an October that bad, really, since going back to the financial crisis. But it really was, I'd say in many respects, a wake-up call. a wake-up call in terms of reflecting on our own investments, reflecting on our financial goals. Where are we at? And is our investment portfolio really ready for a significant decline that's extended and that's sustained? And if your portfolio was performing worse than what the broader market was doing, well, then I'd say that's a problem. That's something you need to look at. That's something that needs to be fixed. And the time that you address that is when market conditions are relatively favorable, which is right now. So taking a look at the broader market, and we try to do this to help you understand the big picture. All right. So taking a look at the total U.S. stock market, which encompasses not just large company stocks like the S&P 500, but we also have to include mid-cap and smaller cap companies because they're equally important. SCHB is the ticker symbol of the Schwab ETF that tracks a total U.S. market ahead by 3% since the start of the year. So that's your perspective, your big picture. Total U.S. stock market in positive territory so far in 2018. Total U.S. bond market, ticker symbol BND, down about 2.5%. VEA, which tracks international developed market stocks, down about 8.5%. Emerging market stocks, VWO, down about 12.5%. Those two areas have been struggling all year long, and we continue to see U.S. stocks with the performance edge for 2018. REITs, which we take a look at this globally, not just here in the U.S., but on a global level, global real estate down about 2.5%, REET. And then commodities, USCI as a group, are down about 3.5%. So the winner clearly in terms of broad asset classes, U.S. stocks, some of these other asset classes down, but down with modest losses. So that's your big picture view. Coming up a little bit later, we'll take a look at what particular industry sectors are outperforming, which ones are leading. We'll also take a look at some of those laggards. 844-305-7800 is the number. How are you doing? Are you closer to your retirement goals than before? Did October shake you out of the market? How is your portfolio doing? Did it meet your expectations? What changes do you want to make? What concerns do you have? 844-305-7800 is the number. Give us your first name along with your city and your ticker symbols. We've also got our Twitter feed, which we'll get into a little bit later. One quote that I wanted to share with you, though, and I think it really summarizes how the market works, is a retweet on our Twitter feed by Jim O'Shaughnessy, and he had this to say. He quoted the great trader of yesteryear, Bernard Baruch, who said, quote, "The main purpose of the stock market is to make fools of as many people as possible." End of quote. That's from Bernard Baruch, one of the great traders during the era of the Great Depression. He was also the same guy that said that the best, what was it that he said? He said that something to the effect of that the best trade that he ever made was getting out early. I have to find the exact wording, but it was very good. And he was known exactly for his precise timing of getting out of the stock market right before its horrific crash in 1929. But that quote, I think, is very symbolic of what the market is and has always been. Its main purpose is to make fools of as many men as possible. And it's really, when you think about it, market prices, and I've told you this so many times before, that market prices are nothing more than a reflection of human psychology at a moment in time. And if that psychology is negative, if that psychology is depressed, if that psychology is sad, you're going to see it reflected in market prices. And that was October. Now we're heading into November. We've got December ahead of us, the two final months of 2018, which historically have been bullish for stocks. And when you take a look at fundamentals still remain quite positive. There are some significant major problems, nevertheless, but we always have problems. That's nothing new. But overall, positive corporate earnings are good. We're heading into a historically favorable period for the stocks. And we've also have a little bit of a rebound here. Can we build on it? That's the question. Can the market build on its gains and find some sort of momentum? 844-305-7800 is the number. We're here. Also coming up on today's show, a rescue plan for retirement late savers. Yes, I've got some new data I want to share with you about people that have gotten a late start to saving for retirement. We've got some good news for them coming up.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
Okay, that legendary trader, Bernard Baruch, I couldn't think of the quote in the previous segment that he said, but then I dug it up, and he said this. He said, quote, I made my money by selling too soon. Isn't that a great, great quote? And, of course, he said that in response to how he made out during the Great Depression and that stock market crash. That's how he made his money. He sold too soon. He also said, and I like this quote too, that to me, old age is always 15 years older than I am. So that's his definition, or was his definition of old age, which I think still holds up today. In fact, that's my definition of old age, is anyone who's 15 years older than I am. 844-305-7800, that's the number. We're here. If you'd like to join us to talk about your own investment portfolio, your retirement goals, any particular stocks, mutual funds, ETFs, you can also tweet the program at Index Show, where we congregate there on social media. Some of the things on the Twitter feed, by the way, I've got a link to a previous program that we did about, do ETFs create day traders? Well, that's a myth. And so we've got a link to that on our Twitter feed at Index Show. That's where you find us on Twitter. Also, a relink or repost from a gentleman by the name of Andrew Thrasher. He said that hedge funds delete the word hedge from their industry title in October as the index declines by the largest amount since 2001. And it's an index of hedge funds, a group of hedge funds. It's called the HFRX Equity Hedge Index. And its monthly return in October down around almost 5%. And that's the largest drop in that index of hedge funds since 2011. That happened again in just October. And my response to that is, this is exactly why the only and proper context for investing in hedge funds and strategies that try to beat an index is strictly in a person's non-core portfolio. That means the core or the foundation of your portfolio should be indexed to the market using broad, diversified, low-cost index ETFs that touch the major asset classes, right? And there's 4 major asset classes: stocks, bonds, commodities, and real estate. And of course, that 5th major asset class is cash. So again, this just further proves why your index or your core portfolio should be indexed versus scrambled eggs and sloppy joes, which is almost 100% of the investor portfolios out there, where there are no rules, where the investor has no division between their core portfolio, non-core portfolio, and then their margin of safety. It's just scrambled eggs and sloppy joes. They're investing in non-core asset classes or non-core investments in their core portfolio. They're taking things like individual stocks and hedge funds and actively managed funds, and they're putting that in their core portfolio. And what do you think that's going to lead to? It's going to lead to market underperformance. It's going to lead to, because inevitably that's what history has shown us, is that trying to play the game of outperforming the market, it just doesn't work. And so that's why we contain that type of investing to the non-core portfolio. If you're going to play the game, play it according to rules that set the odds to your favor. And so this is what we try to help you understand. Now, coming up a little bit later on today's program, we're going to talk about a rescue plan for retirement late savers. Something else on the Twitter feed that I linked to that is very concerning to me and has been for a long time are people that have not saved enough money for retirement. And this is a link to an article from CBS News telling us something that we've already heard so many times before, but that is so accurate and true and really to the times given, that the vast majority of older working Americans do not have sufficient retirement savings. And we're going to talk about that and specifically how to rescue yourself if you're in that situation where you haven't saved enough money for retirement, what you can do to salvage your retirement. So stay tuned for that. That's going to be a subject that we discuss, and I'm going to give you some ideas on things that you can do to help rectify that situation. 844-305-7800 is the number. We're here. Just by way of reminder, if you missed last week's program, we had Dan Dolan of the Select Sector SPDR ETFs with us on the program, and you can listen to that along with all of our podcasts. We archive every single radio broadcast. You can go to indexshow.com and listen there at your leisure. You can also listen at iTunes as well as Google Play and even YouTube. So you can find us there and listen again at your leisure. Now, we talked a little bit about the non-core portion of your investment portfolio. We specifically reserve that part of the portfolio for non-core investments. These are places or types of investments that are typically higher risk, more concentrated in nature, may even use things like leverage, but where you can take advantage of opportunities that present themselves. You can be tactical in your non-core portfolio. You can trade, you can buy, and you can sell, and you can get in and you can get out. That's not typically the case with your core portfolio. Your core portfolio, by design, is meant to be, shall we say, fully invested at all times, right? The core portfolio is meant to be and meant to give you broad asset class exposure that's diversified with an asset mix that you feel comfortable with. And so the non-core portfolio is not like that at all. The non-core portfolio can complement the core. It can buy, it can sell, it can hold lots of cash. It could do a variety of different things. So I just want to give you an example of a couple of trades that were executed here for ETF Guide Premium members and how you can take advantage of market volatility and opportunities that present themselves even when market conditions are not favorable, like October, when markets are sliding. And so these are actual time-stamped trades from ETF Guide Premium. We know that October was a brutal month for stock investors, but thankfully, in the non-core portion of the portfolio, there were opportunities to take advantage of sinking stocks. And a couple of trades that I want to share with you, ETF Guide Premium. One trade was the ProShares VIX Short-Term Futures ETF, ticker symbol VIXY, which was a time-stamped gain. Exited that trade on October 26th for a 12.2% gain. So that was a great trade. That one took several months. In fact, that trade began horrible. That trade, VIXY, was started in May, and for most of the past several months was down substantially. Well, we found a little bit of light at the end of the tunnel, and October hit, and we were able to bang out a gain at ETF Guide Premium in VIXY. Nice gain, of just over 12%. One other quick trade. This was in the Direction Daily Technology Bear 3X ETF, ticker symbol TECS. Banged out a gain of 10.5%. That trade lasted literally just 2 days. Entered on October 26th, exited October 29th, like a precision surgeon. And just another example of trades that you can take advantage of. Go to etfguide.com, become a premium member. And again, for your non-core portfolio, be tactical. Take advantage of the opportunities that present themselves. I'll be right back after this break.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Directions Daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, it's time for a sector check. Let's see what's going on with the major industry sectors. If we break down the S&P 500, we will see exactly what's going on, and it's a curious exercise that we perform quite regularly because it really helps us to understand the market's mood, and it also helps us understand which areas of the market have been profitable to overweight. And if we take a look at the broader S&P 500 since the start of the year, it's ahead by just a nudge over 3%. And if we take a look at industry sectors within the S&P 500, we've got several sectors that have been beating and outperforming by a wide margin the broader market. So, for example, if we take a look at consumer discretionary stocks, ticker symbol XLY, ahead by just over 10% since the beginning of the year. And this has by far been the best performing industry sector thus far in 2018. And it includes companies, retailers. We've got automobile companies, consumer durables, apparel, hotels, restaurants. Some of the members of the consumer discretionary ETF, ticker symbol XLY, include McDonald's, Nike, Ford, Amazon.com, and Home Depot. So XLY, a great performer in 2018, ahead by just over 10%. So another industry sector that is performing quite strongly, and we've talked about this one many times, is the technology sector, which as a group was not a good performer in October, but has rallied back and is still ahead on a year-to-date basis. XLK, 8.5%. XLK tracks technology stocks in the S&P 500. There's 66 holdings. And some of the companies included in XLK are Apple, Microsoft, Visa, Intel, and Cisco. XLK ahead by 8.5%. And again, another sector that's outperforming by a significant margin. One more area, healthcare, XLV, V like Victor. XLV includes 63 stocks, and some of the components include Johnson & Johnson, Pfizer, United Health, Abbott Labs. These are the components in XLV. That particular ETF ahead by a little over 9% since the start of the year, easily outperforming the S&P 500 by almost triple. So that particular ETF doing quite well. And those of you that have been using leverage using leverage in those two sectors, those top-performing sectors, XLK and XLV. I'm going to give you the leverage versions of those ETFs. CURE, C-U-R-E, which aims for triple daily performance to healthcare stocks. That one is ahead by just over 16%. And then TECL aims for triple daily performance to tech stocks, ahead by 9.3%. So that's what's going on in terms of industry sector performance. 844-305-7800 is the number. How are you doing so far in 2018? You made it alive. We made it alive. We survived October. So what comes next? Well, on our Twitter feed, a lot of focus here in the U.S. on midterm elections. And this was something that Donald Trump had to say. He said, if you want your stocks to go down, I strongly suggest voting Democrat. End of quote. That was a quote from Donald Trump. And so I did a fact check to see how historically accurate or inaccurate that statement has been. He said, again, if you want your stocks to go down, I strongly suggest voting Democrat. So I went back and did a fact check. This is, by the way, not a political statement. This is simply a fact check. This is a politically neutral program. So I went back and took a look at stock market returns, going back all the way back to 1930. And so when we take a look at who has been in control in terms of Republican or Democrat, what has been the actual results of stock market performance? And the average return under Republican administrations, 4-year term, 16.5%. That's a 4-year term. For Democrats, the average has been just over 57%. So historically, that has favored Democrats. But the point here that I want you to understand is that this is not a political statement favoring Democrats. It's just a simple fact check that shows that actual historical stock market history has shown that it favors Democrat-controlled House as well as presidency. So these are things that, again, we try to bring to your attention, not to make a political statement, but to just have you understand actual market history as opposed to blind statements that are untrue. I also want to say that I have a link on our Twitter feed, again, at Index Show, that takes a look at this a little bit more in depth in terms of a Republican presidency coupled with a Democratic-controlled Senate and House, what that means, because that could very well play out for 2018. In fact, many strategists see that happening for 2018. Again, a Republican presidency coupled with a Democratic-controlled Senate and House, that historically has been associated with lower stock market returns. And I've got a link to that where you can read a little bit more in depth about that and look at the historical market performance from a company called CXO Advisory, which has great historical data and, again, just helps us to understand the past. Also on the Twitter feed, a retweet by me for David McKnight. David McKnight was a program guest a couple of weeks ago. He has a book out called The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement. This is a quote from former Federal Reserve chairperson or chairman Janet Yellen, who said this in response to the rising U.S. deficit and how that is an unsustainable trend. She said, quote, "If I had a magic wand, I would raise taxes," end of quote. Well, that's exactly what's going to happen in the future. Tax rates are going up. And so the whole point here is to take advantage of historically low tax rates today. And how do you do that? Well, you got to listen to that interview that I had with David McKnight. You can go to indexshow.com or listen at iTunes and just go back to the historical archive and listen to that along with our other shows. 844-305-7800 is the number. We're here. We're going to talk about a rescue plan for retirement late savers. Stay tuned for that. That's coming up. I want to just cite to you a trend that I noticed that I find to be very, very interesting. Most of the year, emerging markets have not been good performers. Now, these are stocks from countries like China and Russia and Brazil. As a group, they have been laggards. I told you earlier, emerging market stocks since the start of the year have fallen about 12.5%. That's a deeper fall compared to developed stocks. But the point here that I'm trying to help you understand is, what is the short-term trend in emerging market stocks? Is there an opportunity to take advantage of a reversal or change in trend? Well, since the start of October, emerging market stocks have actually outperformed U.S. stocks along with developed market stocks. This could be the start of a rebound, potentially, for emerging market stocks. So, again, for October, as bad of a month as that was for the U.S. stock market, it was much less bad, if we should say that, for emerging market stocks, which are outperforming as of October. So this is a trend that I'm watching very closely. EDC is the bullish ETF that aims for triple daily performance of emerging market stocks. I've got my eye on that ETF, EDC. It could be a potential good entry for those of you looking to capitalize on this trend. Well, coming up next, a rescue plan for retirement late savers. Be here or be nowhere.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
844-305-7800 is the number. Give us your first name along with your city if you'd like to join us. If you want to talk about any particular stocks, mutual funds, ETFs, if you'd like to have me analyze and grade your investment portfolio, tell you how you're doing, you can go to portfolioreportcard.com. And I want to mention, too, that when you submit a request for a portfolio report card, you will get a book, an ebook that I authored, 60 Smart Ways to Retire Better. And that's a free ebook for those of you that submit a portfolio report card request. So do that. It will tell you exactly how you're doing in 5 areas: performance, taxes, cost, diversification, and risk. Portfolioreportcard.com. So let's talk about a rescue plan for retirement late savers. I linked this to our Twitter feed, an article from CBS News titled Tough Retirement Realities for Baby Boomers. And the research is from Stanford Center of Longevity, and they find that the majority of older working Americans do not have sufficient retirement savings by the time of age 65. So what they found was that according to this report from Stanford, almost 1/3 or 30% of them have saved nothing towards retirement. For those with positive savings, the median balance was $290,000 for baby boomers born between 1948 and 1953, and $209,000 for those born between 1954 and 1959. So to help you understand just how little that is, if we use the 4% withdrawal rule, and it's just a guideline, it's not hard and fast, but if you had $290,000 in retirement savings and you used a 4% withdrawal rate or rule, that's going to generate just $12,000 a year of annual income, or $1,000 a month. Not much when you think about it in those terms. And of course, you're going to have to add Social Security, whatever you can get from that. But the point here is that to be in this situation where you haven't saved enough for retirement is something that many Americans find themselves in. So what can we do to save ourselves? If we find ourselves in that situation where we have not saved enough for retirement, or we've gotten a late start for whatever reason, maybe it was a crisis, a family crisis, maybe a health medical emergency, or perhaps paying for children's education, perhaps another, whatever, losing a job, any number of factors, a divorce. Things happen in life, and sometimes that interrupts our plan for saving for retirement. So what are some things that we can do now to rescue our retirement plan, those of us that are still working with retirement in mind? So the first thing that I want to share with you is to pay yourself first. And this is so important because sometimes we have the idea that, well, I've got a lot of bills I've got to pay. I've got debt I still have to, pay. I've got a mortgage. I've got all these expenses. Well, I want you to prioritize saving for retirement. So whatever money that you make, those of us that have gotten a late start for saving for retirement, we've got to prioritize. You've got to pay yourself first. And this deals with another aspect, the psychology of self-respect. Those of us that don't pay ourselves first have no self-respect. Because the fact is that you're always going to have bills. We're always going to have to pay something. But we've got to have respect for ourselves. We've got to pay ourselves first. We've got to prioritize saving for retirement. So that's the first thing. The next thing is, if you have a employer-sponsored retirement plan like a 401k or 403b or something, and your employer is saying, well, listen, we're going to match contributions up to a certain percentage, well, then you've got to contribute up to that match. Do not turn away free money. So that's very important. Take advantage of anything that can help you to accelerate your retirement savings, and a company match can certainly do that. The other thing is to live within your means. In his book called Stop Acting Rich and Start Living Like a Real Millionaire, author Thomas Stanley showed how the spending habits of people with more than $1 million in assets were surprisingly frugal. How did they get rich? Well, they avoided the trap of overspending. And this is a very important lesson for those of you trying to get ahead. Instead of trying to keep up with the Joneses, drag them down to your level. It's cheaper. That was, by the way, the sage advice of one comedian. He said, don't keep up with the Joneses. Drag them down to your level. It's cheaper. So will you win the perennial human battle of instant gratification versus delayed gratification? So this is what we want you to understand. Live within your means. Stop overspending on things that don't really matter. The other thing is as you near retirement, it's important that you eliminate or reduce debt. And you should do this in a very deliberate manner. That should be your goal. If you're carrying debt, see if it's feasible to maybe consolidate some of those loans into lower interest charging accounts. If not, prioritize paying off your highest interest debt. Also, it may be worth exploring how to convert non-deductible debt like credit cards or personal loans into tax-deductible debt like a first mortgage. This was something, by the way, that I helped my own mother with just this year. She had lots and lots of, unfortunately, from previous years and from a crisis that happened in previous years in her life, a lot of credit card debt and a second mortgage, and it just became unbearable. And so she, with my help, we looked at trying to consolidate some of that into a first mortgage, and that actually worked out pretty nice because all of that debt now is consolidated in a first mortgage. The interest is tax deductible, and by the way, the payment was much, much lower than what she was paying for all the debt that was scattered about. In fact, she has about $1,000 of positive cash flow every month, which is significant. And so these are little tricks of the trade, financially speaking, that you should be looking at. The other thing I would say that's very important to rescuing your retirement plan is to have a written plan. and a written financial plan. Can you imagine taking a long road trip to a new place without a map or without a GPS? I think that would be the perfect recipe for getting lost. And so similarly, saving and investing for retirement without a written plan, without a mathematically tested plan, is inconceivable. Remember, a retirement plan that's not written down and stress tested is not much of a plan. So you got to know the numbers. And I think working with a financial planner, working with a financial advisor is something that you absolutely should do. A human advisor, not a robo-advisor, someone that really understands you, understands your needs, knows you, knows your family, knows your personal situation and your circumstances. That's not something an algorithm can do. That's not something a robo-advisor can do. A robo-advisor doesn't know the name of your grandchildren. See, a human advisor does. And so that's what I encourage you to do, is to talk to a human advisor, someone that can help you to map all of this out. Also, I've got an online class, those of you that want to learn more, titled Start Now, a Rescue Plan for Retirement Late Savers, a step-by-step plan for having a prosperous retirement. You can go to indexshow.com and enroll in my online class. I've got lots and lots of ideas that can help you, those of you that got a late start for saving for retirement, or you had a crisis that interrupted your retirement savings, things that you can do right now to salvage your retirement and have a prosperous time during retirement. So you can go to indexshow.com to enroll in that online class. Well, that does it for another episode of the Index Investing Show. Be sure to join us again next week. We'll be here, same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.